Welcome to FinWise Now, where global markets meet clarity. And today, clarity is exactly what's on the line. In a week that's shaken up the entire digital asset landscape, the United States has made its boldest move yet in regulating crypto. The legislation at the heart of this seismic shift? The Clarity Act. If you own digital assets, care about innovation, or simply want to understand where the future of finance is headed, buckle up. We're breaking down what's in this bill, why it's a potential game changer, and what every savvy investor and builder needs to know right now. Let's start with a quick recap of a historic week in crypto politics. For years, digital assets have existed in a kind of regulatory gray zone, sometimes welcomed, often scrutinized, and always waiting for Washington to make up its mind. That all changed last week. In a flurry of activity, Congress passed 3 landmark bills that set the tone for the next era of digital finance. First, the Clarity Act itself swept through the House with broad bipartisan support. This isn't just another amendment or a tweak to existing law, it's a comprehensive framework designed to finally answer the fundamental questions that have haunted the crypto space. Second, the Genius Act gave stablecoins what they've lacked for years: full federal recognition. That means the digital dollars, euros, and other asset-backed tokens that power the crypto economy now have a legal standing under U.S. law, setting the stage for mainstream adoption and institutional capital inflows. And finally, the Anti-CBDC Act narrowly made it through, signaling a fierce debate over government-backed digital currencies and the fine line between innovation and surveillance. What's remarkable is how quickly the tone has shifted. Crypto is no longer just tolerated or ignored. It's being structured, shaped at the highest levels of government, with policymakers now actively designing the future of this industry. Whether you're bullish or skeptical, that changes the game for everyone. But what does the Clarity Act actually do? At its core, it delivers what the market's been demanding for years: clear, actionable rules. It draws a crucial distinction between digital assets and digital commodities, 2 categories that determine not only how tokens are regulated, but who gets to regulate them. For the first time, the bill defines what it means for a blockchain to be mature. According to the legislation, a blockchain system is considered mature when it is not controlled by any person or group with more than 20% governance power, and when its value is substantially derived from its use and functioning, rather than from the efforts of a central team. This maturity criterion is absolutely pivotal. It creates a pathway for tokens that start out as securities because they are issued by a company or small team, marketed to investors, and dependent on that team's efforts, to eventually graduate into commodities, regulated not by the Securities and Exchange Commission, but by the Commodity Futures Trading Commission. This process isn't automatic. It requires disclosures, transparency, and a formal certification that the network has become decentralized and no single party is in control. Once these criteria are met, oversight shifts from the stricter, investor-protective regime of the SEC to the more market-oriented rules of the CFTC. For builders, this is a massive win. It means they can launch projects without fearing the threat of endless SEC enforcement actions, so long as they have a credible path to decentralization. For investors, it brings much-needed clarity and reduces the legal risks that have made American exchanges and projects hesitant to list or support certain tokens. It also marks an explicit recognition of the evolutionary nature of digital assets, something that was sorely missing from previous regulatory approaches. But, as with any big shift, not everyone is popping champagne. The Clarity Act passed the House by a wide margin, 294 to 134, but some powerful voices are sounding alarms. Senator Elizabeth Warren has dismissed the bill as a crypto con, warning that it opens the doors for fraudsters and speculators to exploit loopholes. Representative Maxine Waters went even further, dubbing it the Calamity Act and cautioning that it could allow bad actors to slip through the cracks. The heart of the criticism centers on decentralization. while the bill sets a 20% governance threshold for what counts as a control person. Critics argue this is too easy to manipulate. Projects could, in theory, distribute tokens among insiders or structured entities to skirt the rules, while still retaining practical control. And with the stakes this high, billions of dollars, and the integrity of the financial system, skeptics say the definitions need to be airtight. There's also the contentious issue of central bank digital currencies, or CBDCs. The Anti-CBDC Act's razor-thin margin in the House reveals just how divided lawmakers are on the idea of government-backed digital money. Supporters argue a digital dollar could modernize payments and strengthen the country's position in global finance. Detractors warn of unprecedented surveillance powers and loss of individual privacy. The battle lines are drawn, and the Senate is gearing up for a fight that's as much about ideology as it is about technology. So why is the Clarity Act such a big deal? Because it's not just about one piece of legislation. It's about fundamentally restructuring the way digital assets are treated in the world's largest economy. Stablecoins, for the first time, are legally recognized. That's a green light for banks, fintech firms, and major corporations to engage with these assets without fear of regulatory whiplash. Tokens finally have a defined pathway to regulatory safety. Start as a security, meet the criteria, become a commodity. This is a roadmap that builders and institutions have been clamoring for, and it could unlock billions, if not trillions, of dollars in capital that have been sitting on the sidelines. It's also a clear signal to the world that the United States wants to be a leader, not a laggard, in the digital asset revolution. For years, regulatory uncertainty has driven innovation and talent offshore. With this act, Congress is betting that clear, predictable rules will keep the next generation of financial technology at home, fueling job creation, economic growth, and global competitiveness. But, and this is a big but, everything now hinges on the Senate. The bill's journey is far from over, and the next steps could determine whether this moment becomes a turning point or a missed opportunity. In the upper chamber, we're likely to see intense negotiations over the definitions of decentralization, with some senators pushing for stricter criteria to prevent abuse. There will also be calls for enhanced fraud protections, tighter controls on token sales, and more explicit timelines for when and how projects can transition from SEC to CFTC oversight. Partisan priorities are coming into sharper focus. Republicans are advocating for clear, predictable roles for the SEC and CFTC, robust support for decentralization, and the right to self-custody digital assets. Democrats, on the other hand, are focused on stricter investor protections, anti-money laundering safeguards, and greater oversight of stablecoin issuance to prevent systemic risks. The timeline is ambitious. Lawmakers are aiming to bring the bill to a vote by September, but budget negotiations and political jockeying could push it into late fall or beyond. If the Clarity Act passes before year's end, it will usher in a new era for crypto in America, one defined by certainty, structure, and perhaps even legitimacy in the eyes of mainstream investors and institutions. If it stalls or is gutted by amendments, the industry could find itself right back in the regulatory chaos that's hampered growth for years. So here's the bottom line. The Clarity Act could bring the certainty, structure, and legitimacy that digital assets have desperately needed. It could provide a stable foundation for innovation, attract institutional investment, and cement the U.S. as a global leader in crypto. But it could also be watered down or derailed by politics, leaving the market in limbo and innovation at risk. Now, it's time to hear from you. Are you in favor of the Clarity Act? Do you believe crypto needs clearer rules and government recognition? Or do you worry that regulation could stifle innovation and backfire? Your voice matters, because the future of finance is being shaped not just in Congress, but by everyone who participates in this ecosystem. Don't forget to share your thoughts in the comments below. Like, subscribe, and stay tuned for our next deep dive, where we'll explore why central bank digital currencies could be both an opportunity and a trap for financial freedom. This is FinWise Now, where clarity meets capital. Thanks for joining us, and we'll see you next time.